Most people think banks profit off random fees, but the real engine is simpler. Once you see it, you bank smarter. Here's what you need to know. Most bank profit isn't mystery fees or overdraft alone. It's the spread between what they pay you and what they earn using your money. Your deposits don't just sit. Banks use them to fund loans and investments. Fees matter, but they're not the whole profit, and overdraft is only one slice. Cards don't only cost banks because swipe fees exist. Transfers aren't always free, and interest can help them too. The core business model is net interest margin. Banks borrow money cheaply and lend it out at higher yields. Borrow short, lend long, means deposits and short-term funding can reprice faster than long-term loans like mortgages. Deposits are cheap funding compared to issuing debt, especially when many accounts pay little interest. Loans usually earn more than safe assets, so they drive income. When loan demand is weak, banks buy securities, and because interest accrues daily, balances quietly earn them money every day. Fees still matter because they're high margin and easy to trigger in real life. A $30 overdraft can hit multiple times in a weekend and stack fast. Out-of-network ATMs can double charge, your bank's fee plus the ATM owner's fee. Maintenance fees recur monthly unless you meet requirements like a minimum balance. Wires are priced as premium payments, even if they're mostly electronic. Card swipe fees pay banks a few cents to a few percent per purchase. Add-ons like identity monitoring or paper statements also create steady revenue. Banks can't just scoop up deposits and lend endlessly because every dollar has limits and risks attached. Deposits aren't a free pool. Banks pay interest, run branches and apps, and cover compliance costs. Capital buffers, basically a required safety cushion, limit how fast they can grow loans. When borrowers don't pay, charge-offs reduce earnings immediately. Fraud losses show up somewhere, which is why fees and tighter rules exist. Holds help prevent bounce checks and ACH returns. And FDIC insurance protects you, not the bank's profits, so banks still manage risk aggressively. Once you know how banks earn, you can stop donating money to the system. Move idle cash out of low-interest accounts so the spread works for you, not against you. Set overdraft to decline for debit card and ATM transactions so a mistake becomes a decline, not a 30+ fee. Compare ways to waive monthly fees like direct deposit or minimum balances. Use ACH for routine transfers instead of wires when time isn't critical. Learn your ATM network rules to avoid stacked fees, then set alerts and autopay to prevent late payments and surprise negatives. A single $35 overdraft fee happening twice can erase months of interest on a typical checking balance. BankingHub matches accounts to how you actually bank and shows the real dollar impact for your balance. Free, 2 minutes, no login. Links in the description.